to Ajua webinar series, Stay Alive. Stay Alive is a campaign, especially for businesses, which we're saying that we are urging businesses to look at ways that we can discuss together a way that our business can stay alive and thrive still during this challenge, but also accelerate post-COVID into a recovery. I will ask Kenfield to do further introductions of Ajua, and then of Dr. Habil. Kenfield, the CEO of Ajua. Welcome, Kenfield, please.
Hi, thanks, Gilbert, and thanks everyone for joining us on a Friday. Happy Friday to everyone. This is, as Gilbert mentioned, Ajua's Stay Alive, Thrive as a Business webinars, and we're really excited to have Dr. Habil to join us. And Gilbert mentioned that, this is a session for us to really think about, how do we come together as intellects, as business minds, as entrepreneurs, and really think about getting through this time with this pandemic, and also look at the future as far as post-pandemic. So we're really excited to have Dr. Habil to join us in discussing more on the financial sector and the banking sector. So Dr. Habil's from Kenya's Banking Association, and his background is obviously in finance, and really rooted in understanding exactly how this may have an impact on us on the short term, medium term, and long term. And let me just give you some background. He holds a doctorate of business administration from USIU, a first class honors, Bachelor of Science from degree of electrical engineering, so as an engineer as well, and an MBA of finance from Manchester Business School in the UK. So we're really fortunate to having Dr. Habil Olaka to join us and really take us through his insights and how he sees this playing out from a digital transformation and how this is impacting banks and traditional financial services. So I'll hand it over to Dr. Habil Olaka.
Yeah, thank you very much. Thank you very much. Indeed, for me, it's a pleasure to be invited on this Ajua webinar. And I think the issue that I was requested to talk about how COVID-19 is transforming the banking sector in Kenya, I think is a fairly wide topic. And the way I would want to approach it is we have a more or less interactive session at the end of which we can have the Q&A and see how we can be able to interact across, because I think we never had a rehearsal for this COVID-19, and many of us are grappling through ramifications of what it's bringing to the table. And so I wouldn't approach it like I'm the expert on the issue, but I think it's a learning experience for all of us. Having said that, I think this pandemic has afflicted the economy at a time when the banking industry is in a very strong footing, as the rest of the enterprises and households are actually struggling. I say a strong footing from two perspectives. One is that the banking industry is fairly liquid at this particular point in time. If you recall, towards the end of last year, there was a law that was in place that had capped the interest rates in the banking sector, and therefore the credit activity had really slowed down. So upon the capping law being lifted, there was some breath of relief in the banking sector, and so it was opening up the banking sector to be able to bank was fairly liquid, with the liquidity that had been locked in, not able to be on lent to the borrowers. So it's coming at a time when credit was beginning to pick up, and therefore banks were very, very well placed to be able to respond to that. The other point that makes me think that the banks are a very strong footing is at the level of the capitalization of the banking sector. If you look at all the reports that are essentially released by the central bank, it shows the banking level capitalization well above the regulatory minimum required by the regulator. So I think the banking sector, partly because of the level of regulation by the regulator and a keen eye kept on the sector by the regulator, and the need to maintain buffer capital levels as a matter of regulatory requirement. I think that has put the banking sector on a very strong footing to be able to respond to this challenge. And as an industry, the banking sector will be inevitably the first responder to support the afflicted economy, while at the same time trying to ensure that we preserve the stability of the financial system. And the stability of the financial system is important because we do not want a health crisis, so to speak, evolve into a banking crisis, so that we resolve the health crisis, and at the top of it, we are left with a banking crisis to struggle through it. Because the economic cost of resolving a banking crisis may possibly be much more than the economic cost of resolving a health crisis. So as I've said, I think the banking sector is sufficiently capitalized. If I can give some level of comfort to the consumer public that the banking sector is adequately capitalized and will remain so even under extreme stress that may come out of this pandemic. And therefore, a number of response mechanisms have been put in place to ensure that the banking sector is in a position to support the borrowing public. And I think I can look at this from, I would say 2 levels. One is providing relief to borrowers, and that is borrowers who are already borrowers from the banking sector. A number of measures were put in place, supported by the central bank. If you recall, central bank made some significant steps. One was to lower the central bank rate. In fact, the central bank rate has actually been lowered twice in very quick succession, from 8.25 to 7.25 in the first move, and then from 7.25 marginally to 7.0% in the latest move by the central bank. And all that is meant to reduce the cost of funding in the market, and therefore enable the banks to be able to provide this support to the borrowing public in a much more affordable cost structure. Talking about cost, the central bank has also made some very specific moves to enable the banks not only have cheaper services, but also move the transacting public from the physical handling of cash, for example, in the banking halls, and trying to push them onto the digital platforms. So to enable this, central bank coordinated both the banking sector and the mobile network operators to be able to reduce the cost of transacting on their respective platforms, to enable customers move away from physical handling of cash, but also being in the physical halls, banking halls, for example, onto the digital platforms. And this was an activity that was coordinated by central bank between the MNOs and the central bank, and the banks, to reduce the cost for doing that. The other reason for this is because physical cash is known to be a possible conduit through which the virus can be transmitted from one person to another. And therefore, trying to move the transacting public away from the physical handling of cash and the physical interactions of coming together during the transaction, away from cash onto the digital platforms to enable the measures that the government is trying to put in place of social distancing and all that to be implemented effectively. So just going back onto the relief that banks have been able to give, I mentioned about the central bank rate coming down. The other significant move by the central bank was to reduce what you call the cash reserve ratio, which essentially the cash reserve ratio is a proportion of the deposit base of the banks that banks are got to retain at the central bank in an interest earning account. Now, by reducing that ratio, it means that the central bank is effectively releasing liquidity to the banks to be able to on-lend to the customers. So through that move, central bank is facilitating the banks by availing additional liquidity to the banks to be able to support their customers. Another move that banks did was, for example, to zero rate transactions on their digital platforms. So for instance, transactions that are transacted on the PesaLink platform have been zero rated for the next 3 months. I think it runs up to end of June, just to ensure that we have got as much ease on transacting on the platform as possible. And depending on how the pandemic develops going forward, the timeline of June was more or less indicative at that point in time. But if the need arises, that timeline can be moved forward to still enable borrowers to be able to, or other transactors on the platform to be able to transact in a more affordable way. Now, one of the challenges that I've always encountered is the fact that all these measures have been put in place and they seem to be supporting the customers who already have a borrowing relationship with the banks. Now, there are a host of SMEs and households out there who currently don't have a borrowing relationship with the banks. And therefore, from what I've said so far, it looks like they may be excluded from the envelope of the entities that banks are looking for to support. And this may not be so because there is also the approach by the banks to try to extend additional credit to borrowers. And this means either a top up for an existing customers or fresh credit to new onboarded customers on board. And a number of measures are also being put in place to facilitate this. One is the fact that banks are facilitated through additional liquidity from the central bank. And then two, in view of the fact that the risk profile of the additional lending is fairly enhanced in the current environment. The banks have more or less tried to put in place a structure where there is some element of risk sharing between the banks per se and a credit guarantee kind of structure that will then enable banks have a higher risk appetite for the new borrowers that may effectively come in. And one of the things that possibly I need to also stress at this point in time is the fact that as banks position themselves to be able to support the evolving developments in the market in terms of demands from the banking sector, either to restructure the existing facilities or to on-lend further credit. I think there is that need to strike a balance between sustaining the existing portfolio in a way that it's not deteriorating vis-a-vis the growth opportunities. So you are looking at trying to grow your portfolio in terms of additional lending vis-a-vis trying to ensure that the existing portfolio does not deteriorate. Because as I mentioned earlier, we do not want to resolve the health crisis and swiftly move into a banking crisis thereafter. So there is a balance that needs to be struck between, maintaining the quality of the existing portfolio vis-a-vis, extending additional, or rather looking at a portfolio growth. There is also the need to balance between, as I mentioned earlier, restructuring, which is an indication of low credit demand, and the continued flow of credit, which is continuing to support new customers who are coming on board, and even the existing customers who want additional credit. Then there is the tricky one, which is the fact that some of the measures that the government is putting in place to address the pandemic will require resources. And this resource needs effectively means that the government is continuously going into a fiscal deficit and sinking deeper into a fiscal deficit. And to bridge that gap, it may as well require going out into the market to borrow. In other words, incur additional debt. So banks then have got that balancing act of either investing in new loans, as in extending credit to the private sector, or investing the additional funding into the requirements of the government, which is through the treasury instruments. So there's need to strike that balance. And in my view, therefore, if you ask me about the question in whether there'll be a sustained credit growth, I think, in my view, given the factors that I've highlighted, this growth is bound to remain modest, most probably within the single-digit level for the foreseeable future. So, going back to the question that we raised at the beginning, in which way has the development or the impact of the COVID pandemic transformed the banking sector, and in which way how are the banks responding to this, and how is it changing the banking environment? And I think one of the ways in which this is clearly visible is in the optimization of the use of technology in a way that then reduces the human interaction as a principal mode of operation. Remember, I mentioned a little bit earlier about the banks trying to shift most of the transactions onto the digital platforms, essentially as a response to the government measures of trying to ensure that there's social distancing and minimizing the interaction between individuals. And so we find that not only in our transacting platforms, but even within the banks as a means of interacting. We are now beginning to use technology more. Even the use of the webinar like we are doing right now. Initially, I think this would have been more or less a physical meeting, but we are now finding it much easier to leverage on technology and be able to transact and have these human interactions. So it's picking up really in the banking sector. If I give an example, like at the association, we have had 2 board meetings after the government announced the measures. We have had 2 board meetings. We have had 1 general meeting with all the members, and we have had several management committee meetings within the association, and all of them have been online. Something that previously would not have been possible, because there would have always been, all sorts of reasons why that's not effective, including the security of the platform and the like. But somehow, because of the need right now, we have found it possible to actually shift all this human interaction onto the digital platforms. One of the other things that I mentioned a little bit earlier as we were discussing, as waiting for the meeting to start, was the fact that currently, for instance, I'm in the office alone, but work is going on, and people are working from their homes, away from the office. People are now effectively putting in place what we used to talk about in terms of flexi time. So we do not have the 8 to 5 working schedule, but people more or less have got to work at different times. The critical thing is now the productivity, and the HR function will now have to change on how to measure productivity and how to measure performance, performance management rather, through using different metrics from what you have usually been using, or tweaking them a little bit in view of the changing working environment. The other thing I think is the business continuity plans and the strategies that that have been in place. I think will have to be pulled out, dusted, and enhanced effectively, because I think many of us now are operating from our business continuity plans in terms of are they effective now, and you can now see practically whether the business continuity plans that you had in place were effective or not. And then finally, I think some of the dynamics, like the relationship with suppliers, the relationship with, for example, for us in the banking sector, the relationship with the regulator has in a way completely shifted, and the dynamics are now becoming very fluid because, for instance, even the meetings that we used to have with the regulator are now all online, and initially could not be held online because of security concerns, but somehow the security concerns have been either not flagged as important anymore, or not as that significant to stop us from riding on those platforms, or just been somehow overcome. So the relationship with the regulators, with the suppliers, with the other stakeholders within the supply chain, I think will be a totally different place. And therefore, I think rather than looking at post-COVID, my view is that we look at a core COVID kind of scenario where COVID will be with us. The kind of changes that COVID has brought around are bound to remain with us even after the direct impact of the disease has effectively minimized the point whereby we are no longer having the health challenge, but the social repercussions of the health challenge, I think, will remain with us for some time. We will still find it difficult to get cozy together within the less than 1 meter distancing from one another for quite a bit of time, even after this COVID is gone. So I think the way forward is that our interactions have, in my view, almost like permanently changed, and we just need to now start adapting our environment to the new developments. And so as a conclusion, I'll just go back to the point I mentioned at the beginning of the fact that I think the banking sector is on a very strong footing to support the economy. By the economy, I mean the enterprises and the households that may be struggling to wade through this pandemic. Thank you very much.
Thank you so much, Dr. Adil. I really appreciate quite some insights and that you've displayed, and actually you've gone quite broad and deep as well into several of the areas that really have been eliciting a lot of questions, especially the responses by the banks, the need for balance has been quite a bit of a topic, and is this disease there with us for now, or is it after? What is post-COVID like, and how should we expect behaviors? Also, it's very encouraging to listen to what you are doing yourself as KBA, and some of the institutions that KBA manages, like Pestlink, right, where our transactions, everything is still going on very smoothly, despite them all working from home. So that's quite a testament to what the country or institution has actually done to really react to this in terms of being able to have complete continuity of business whilst not physically present in the office. And this is very, very encouraging. I'm not sure if that's encouraging to you, to your landlord. Right? I'm not sure. I'm not sure if your landlord is very happy about that, if you will ask for contracted space. But I guess, the world is reshaping itself across all sectors, and we all have to figure out how that post-COVID looks like for us to all stay alive. And before I start on a couple of the questions that I wrote myself, and I'll also look at what questions the audience have. So, but again, just a reminder, please, to the audience, kindly, please do put your questions in the Q&A or in the chats. We'll pick them up shortly after these few questions that I've got. So, you know, you've explained how you see COVID as more an endemic, being with us beyond the current, you know, crisis. And I see, or we see COVID as the disease and COVID as the induced behavior that could become permanent. From a banking perspective, which, maybe from an institution, but also from the public, which behaviors, institutional or social or process, do you see will outlast, at least in the medium to long term, the current crisis?
I think one of the, and thank you very much for that that question and the broad summary. I think one of the areas that certainly, and it's something that has started earlier, but what I think COVID has done is that it has accelerated that transformation. The whole idea of moving transactions from the manual processing onto the digital platforms, be it either the mobile platforms or over the internet, or even using plastic cards for that matter to effect payments. I think we are going to see that acceleration now moving much faster than we had initially anticipated, because it's now an issue of your behaviors being almost like accelerated by other factors other than just the convenience of the platform. So now is the issue of convenience, because transacting over a mobile platform, for example, or over the internet, or on a gadget that you have, is convenient. But also now there is the issue of safety. So because going on to, you then avoid physical interactions, either in the banking hall or physical interactions in terms of actually physically handling the money and taking that money to make the physical payment. And at the point of interacting at the physical payment, you necessarily have got to get into close contact with the person you're transacting with. So by moving transactions away from the physical transactions onto the digital platforms, not only are you achieving then the convenience that you were initially advocating for, but now we are also introducing the issue of safety for your own personal hygiene and health safety reasons. So I think that's an area that you're going to see quite a bit. The other thing, for example, is what you alluded to earlier in terms of if all of us are going to now start thinking seriously about allocating part of our time to working away from the office, even if it's not full-time working from the office. The other day I saw, I think, Twitter, who have said that all their staff can work from home, for the foreseeable future. I think, in fact, it's forever, I think. And I think that may just be the first announcement, but you're going to see a number of entities going that direction, where people are given the flexibility to either to choose whether to work from home or work from the office. And a number of them are going to prefer that option. Now, when you go that route, you'll find that the space that we have in the office, do we still really need it? As I mentioned, right now I'm in the office alone, but work is being done. So do we still need this whole, flow of an office when we can actually be able to do without the space that we have, been occupying? So I see a number of changes coming up. Some of them will definitely be permanent, but those are the ones that I see as the immediate ones that will impact the banking sector post-COVID.
So My next question will be, I will be going deeper into the banking part regarding liquidity, but just before that, looking specifically at the bank, at the new processes that the banks had to do to react to the current challenge. So you've seen branches closed, we've seen waivers of fees on money, moving money at certain levels, depending on which banks. We've seen waiver, I believe, on ATM withdrawals, right? Or yeah, I believe so. Or moving money from M-Pesa to your account and vice versa. I think that's the most critical one from a cashless perspective, and many other initiatives as well. Now, we saw when the whole ATM move came in, and then the whole going application versus going to a physical branch, going digital versus going to a physical branch, and a couple of banks in your association did close several branches as well. Now we have seen another closure happening this season, induced by COVID, right? And on looking at that, I'm thinking, now this might sustain for a total of maybe 60 to 90 days, which is enough time to create new behaviors. What are your banks thinking regarding that? Are we seeing the next onslaught that says maybe we were able to do okay with less branches, and therefore we might continue that way? We might not need a real estate at that point. And also for the interest of the public, some fees that were waived, like moving money between M-Pesa and your account, right? Do you see some of your banks saying, what, let's waive that as well continuously, because we're able to sustain in that way? Because I think post-COVID, the public will need more cushioning, even post-COVID, more than now, because the safety net from some of the surveys we've done as Ajua is very limited. There's literally no safety net for a large majority of the public. And therefore, it would be great to see some of those institutional and process behaviors induced by COVID in the banking sector specifically, especially on the age of the customer, continue beyond just this particular lockdown period. What do you think? And what would be regarding that?
Yeah, I think you raise valid points, and if I can just touch on, you raised it about the physical infrastructure, and then the one about the fees and the moves that banks have done, and whether this is seen as a possible permanent scenario, or will they revert back to the pre-COVID scenario. And if I can just go on the issue of the fees, I think, it's an issue of looking at the cost-benefit analysis. At the end of the day, the cost for the bank would be the foregone income. So you are really foregoing income, but there is a benefit that comes with it. And if the benefit outweighs that cost, then it might as well remain a permanent thing. Like, for example, if you're able to get more customers transacting by virtue of the fact that you have brought the fees down, and from that customer, you are able to generate additional revenue from other services that you're offering the customer, then, really the issue of, and what has led the customer to bring the wallet to you is because you have actually reduced the fees or maybe waived the fees completely. It's not rocket science. Most likely the bank may see the logic of making the fees waiver be permanent. After all, because on the other hand, you are compensating for the foregone income through the additional wallet return on the other end. So I think it's a thing that we can't say which way it will go, but I think at the end of the day, the economics will be such that it will make sense for the bank to waive the fees and generate more service provision levels with the customer once the customer is transacting on their platform. That's one. And talking about fees, I can, for example, the case of PesaLink. You see, PesaLink, it was a decision by the banks because PesaLink is effectively owned by the banks, and it was a decision of the banks to waive all fees that are related to the PesaLink platform. And this is because it then moves, transactions away from the other platforms onto the Pesalink platform, and for supporting the bank-to-bank transfer, or rather account-to-account transfer through the Pesalink platform. I mean, the way I see this is that post-COVID, it may not completely be zero, because at the end of the day, Pesalink itself has got to survive and be sustainable as an institution. But what most probably may happen is that the fees that the customer meets is an element of what Pesalink as a platform charges, and then what the banks, either as a sending or as a receiving entity, charge from their end. And I think that's where the cost-benefit analysis now will also come, because the bank that is charging something for sending and the bank that is charging something for receiving, I think they're bound to bring that down if the revenues, if the number of transactions or the volumes for that matter pick up by virtue of that. So the argument still remains the same, whether on the Pesalink platform or on the direct fees transaction. I think the argument remains the same. On the issue of closing branches, I think that's a bit of a tight one, because one is that the few banks that have announced some closure of branches, they have been very specific, and they have been for some very specific reasons because of the current environment in which we are. Currently, the traffic, for example, if you look at the case of a few where you've got a branch, for example, on Kenyatta Avenue, and another branch on Harambe Avenue, and possibly another branch on Taifa Road, you may find that given the traffic currently in town, you may not need to have those three branches open as of now. But I think after the COVID and things normalize back and the traffic resumes, it may remain a justifiable reason to actually keep the branches open. There might be some rationalization. The example I gave of having 3 branches, you may find that after rationalization, maybe you might have 2 instead of the 3, but not having 1 as it is now, because right now you have closed all the other 2 and remained with only 1. So after things pick up again, you may find that you rationalize, and now you bring in a number that is a little bit more than what you have currently, but less than what we had initially before, or the pre-COVID period. So there'll be that rationalization. But I think at the end of the day, definitely the period post-COVID will be a very different one from what we have now.
Great, exactly. And definitely one horse that has bolted is a real estate horse. I think that one has bolted. And I think a lot of your banks are vested in real estate as well, right? And therefore, I think that's a whole different topic on how that needs to be covered to make sure we don't have another NPL crisis, because in the medium term, right? Because there could be a series of not just defaults, I think, in the real estate, but just from a corporate perspective, reorganization of what an office space needs to be. From the surveys we've done and from the various webinars we've attended, it looks like from an institutional corporate perspective, the real estate part is one where we need to start preparing for and start to create strategies. And especially, I know that banks are involved in that, and therefore, there could be a reason to start to pay, very good attention to that. The mortgages part presents itself a bit earlier because restructuring that is difficult at the early stage. Therefore, it presents early, but I think the institutional ones will come a bit later. But they're just my own opinion. I leave it there.
Yeah.
The other horse that has bolted, and I would like you to comment on, is the M-Pesa horse. Right. So just another to all the audience, please put your questions in the Q&A. I'll just get into it right now. I've seen one that's very interesting. I'll get to it just now. So on the M-Pesa horse, right? So the doubling of the limit, or the increase of the limit, let me call it that, or limits to how much we're able to transact on M-Pesa now means one can hold a little bit more on that than they could need to hold, in a bank account, because I couldn't do it on M-Pesa, right? So if, for example, I need to transact a certain amount, and I couldn't move it all to my M-Pesa account. I have to wait till the next day, and then now I might be able to hold much more on my M-Pesa account, and I believe majority of SMEs and the public are in that bracket of that value. How are your banks going to react to this? Because I don't think that horse is going back. It's the typical, toothpaste is out of the tube. You try to bring it back in, it's going to be messy, right? And that's why I might ask about some of these institutional behaviors or a process behavior that might need to be permanent in terms of some of those fees. Because if you're going to charge me fees, I'd rather just keep everything on M-Pesa if it can allow me to put 150K in there and just hold it there, right? What's your opinion on how banks need to react to this? Because it's not coming back.
Yeah, I mean, I think there are a number of issues that you raised there. There is the issue of, the M-Pesa wallet. And maybe not M-Pesa alone. I mean, I think the whole move was affecting the telecom, product as well as the Airtel one and the M-Pesa one. But of course, M-Pesa is the main one, and therefore we can use the example of M-Pesa as a default for all the mobile wallets, so to speak. And I think there was the amount that you can transact was raised, and also the amount you can hold in the wallet was also raised. And therefore, the point you raise is the fact that it will then be easier for a normal transactor to actually put more in the wallet for purposes of effecting the payment. And I also notice the fact the issue of the cost differential, so that if the banks are charging as much, then a customer will find it easier to just leave the money on the M-Pesa wallet and pay from there. And I don't know whether we are comparing the cost differentials between the two transactions. I mean, between transacting from the M-Pesa wallet and transacting from the bank account, because most probably I think that differential will not be quite tilted in terms of the fact that the banks are the more expensive alternative. I think the point there is that it has been made more convenient. So irrespective of the cost, the customer may still find it more convenient to put the money or leave the balance on the M-Pesa wallet and therefore transact from there, irrespective of the cost. Because I don't think the driver for the customer to be moving that way is because it's cheaper on the M-Pesa platform. I think it's just because it now becomes more convenient and you can do a bit more transactions that initially could not, because initially you couldn't transact more than 70,000. Now it is 150. You couldn't keep on the wallet more than 100,000. Now it's 300,000. So there is much more room. But in terms of the cost, I think if we did the transaction by transaction analysis in terms of the cost of transacting, I think we'll still find the banking cost still much more competitive than you'll find on the other platforms. So I think it's an area that's evolving. It's obviously means that the consumer behavior will now shift quite a bit of balances to be left on the M-Pesa wallets, and therefore denying the banks that float to enable the customers transact on the banking platform rather than on the M-Pesa platform. But I think the market is still evolving, and it is something that has just been brought in for purposes of enabling customers, wriggle within this COVID environment. And of course, there are other dynamics that will come in, but I think as we go along, the competitive structure will be such that if it's an issue, for example, bringing down the cost so that we can, have a level playing field, I think it will evolve itself. So it's an area that we need to watch carefully and see how the place evolves. I think that at the end of the day, it is putting the power to the consumer, so that it's an issue of the one who is most competitive and the one who gives the most convenience is the one that will attract the customer.
Understood. And looking forward to that. And well, who knows, right? Maybe you could have another bank in the offing, a digital bank. And based on that digital bank, is this an opportunity? I'm looking at picking from the M-Pesa discussion, because possibly this is typically what other countries are presented as a complete digital bank, right? Flipped differently, right? But it almost has the principles of how that works. Now, moving out onto a question from Nuru here that is asking, what is the biggest challenge to converting to a fully digital bank end-to-end? Because probably maybe we are ripe now in Kenya to have a complete end-to-end digital bank, like we've seen in other countries, right? And they're quite interesting examples on how those ones have served interesting demographics, like the complete millennial and sub-millennial demographics, and how what that has meant to them from a banking perspective. So what are the current challenges you're seeing now? Or these black swan moments, could it be an opportunity for somebody to arise and become a complete digital bank, end-to-end?
Yeah, I think you raise two possible trains of thought from what you are raising. And the two trains of thought is this. One is, what are the steps that an existing bank currently, which is more or less a brick and mortar bank, because that's what we have currently, converting into a digital bank.
Completely,
yes.
End-to-end.
Yeah, completely, yes, yeah. And then the other one is weighing that vis-a-vis an entity today starting from Greenfield and getting licensed as a bank, but purely on a digital end-to-end. You see,
correct.
And those are the two possible scenarios. Now, and I think also we need to also be alert to the fact that banking services is possibly, and in all markets, is possibly one of the most heavily regulated sector. And so the role of the regulator is critical in what banks can and what they cannot do. And this regulation, this heavy regulation, is for a very good purpose. Partly because, and essentially because, banks operate on trust. You get the banking public's deposits, and then you on-lend those deposits to borrowers. That intermediation, you actually are operating on public funds. So the need for the regulator to ensure that you are doing that intermediation, role within set guidelines is critical. So the role of the regulator in the banking environment will be critical. And there are things that the regulator will allow for good reasons, and there are things that the regulator will not allow, or rather will be slow in responding to, because of the fact that structures have been put in place to address specific requirements within the banking sector to assure the regulator that the regulator is in control of the industry, or of the sector for that matter. Now, I'm doing this because whether you look at it from an existing bank, which is currently licensed, and therefore requiring to, or rather trying to move from a brick and mortar entity into a fully digital environment, end to end, there are requirements that will be required from the regulator to satisfy the regulator that even as you do the conversion, you are still having a process that safeguards the funds of the depositor. Now, if you are a new entity, you also have got to go through the same, because at the end of the day, for you to become a bank, you'll have to be licensed by the regulator, because you'll be taking in funds from the public and leveraging on those funds to on-lend. And therefore, there's an element of public trust in whatever you are doing. And therefore, the regulator must ensure that you have met some minimum requirements before he can give you that license to operate on the public trust. So either way, I think there is the issue of, you might find that the regulator will have to necessarily draw you back. There are things that you may want to innovate and move with the demands of the market and the requirements of, the banking public and all that. But the regulator will pull you back for a good reason, because he has got to be satisfied of the fact that you're actually safeguarding the public trust that you have, and you're operating on public funds, and the regulator is there to ensure that the depositors' interests are safeguarded at all times in terms of your operations. So those are the dynamics that you have to work through. And whether the existing development will accelerate that process, either from an existing bank converting quickly or a greenfield coming up with a proposition and getting that approval through the process. I think possibly some of the things that have occurred during this time could accelerate the approach that the regulator would give such kind of propositions. So to your point again, I think it's such developments like the COVID that then sort of like ignite the regulator to start looking at possibilities of how to move the industry forward and leverage on technology, leverage on new developments. There are a number of developments that are coming up in the space that banks can leverage on to not only assure security, for example, safeguarding safety or convenience to the customer, or even efficiency in terms of the transacting, and therefore the cost of transacting to the customer at the end of the day going down, but which have not necessarily been slowed down because of the requirement to satisfy some specific requirements from the regulator.
Got it. That's a good question from Nuru, and thank you so much for that for that answer. And still on the digital, there's another question here regarding KBA as an advocate for digital solutions, right? So, question is, are you going to gently push? You're an association of the banks, yes, but you also you sit where you sit. So, are you gently pushing everybody, whether it's tier 1, tier 2, tier 3 banks, to now start adopting digital solutions, especially for onboarding customers and all that, right? So, what are you guys doing around that? And how do you see your role based on what we've just seen during COVID, in terms of the banks that could survive or not survive, because depending on who adopted more technology than the other one already, will you be advocating towards digitization as much as possible for customer experience for most of the banks?
Yeah, I think your question can also be looked at from two perspectives. If you look at currently, the biggest challenge that the banks have will be twofold. One is trying to ensure that their services are, consumed by as much of the public as possible. So really trying to look at the market share, so to speak. The other one is what everybody will point out of the fact that the cost of the banking services is a major concern. And therefore the two, in terms of getting the services accessed by as much of the public as possible, and then bring the cost of those banking services down. Incidentally, the solution to the two lies more in adoption of technology than anything else. You can use technology to be able to reach as much of your target market as possible, leveraging on technology through, the various platforms that have come up and innovations that have come up. And also in terms of, for example, platform sharing or interoperability, as we would want to put it. Through such kind of sharing of infrastructure, we effectively bring the unit cost of transacting on the platforms down. And both approaches actually are leveraging significant on technology. So to your point about what is the KBA doing about that, and we have got a very active engagement with the banks in terms of trying to identify areas in which technology can be leveraged on to not only increase our market share, but also bring the cost of banking services down. As we speak, we launched our strategic plan 2019-2023 last year. So this is the second year of implementation of the strategic plan. And one of the pillars that we have is actually technology, trying to support the banks to leverage on technology to expand either their envelope or access to the customers, but also leveraging on technology to bring the cost of banking services down. So yes, to your question, we are actively mandated by by shareholders to ensure that we actively look for ways in which we can support the banks to leverage on technology to have an offering to the consumer public.
Great. And we have time for only just one or two more questions only. But I guess this M-Pesa question, goes deep. So the next one is this question regards credit and credit evaluation. So right now, if you go to get a loan from a bank, they ask you for your bank statements or for that of your company. And because most people will be operating in the realm of M-Pesa now, with a 300,000 shilling limit, that is quite high. For a lot of businesses, that's okay. That's pretty much all they need. And then that's how they'll be transacting. So if they go and ask for their bank statements for an evaluation of credit, the question is asking, can I also present my M-Pesa? Because that's also a realm that, from a business perspective or a personal perspective, I've been operating in almost like a bank account. So are we seeing a situation where you can even advocate and say, listen, when you're doing a credit evaluation, don't just look at the bank statements. The person might actually have zero there or very little. Most of the transactions they'll be having is on M-Pesa, and that needs to come together, in credit evaluation for facility. Where do you see this headed?
Yeah, I mean, you've got a valid point in the sense that as the consumer behavior changes, I think the areas in which you can be able to track the credit performance of the consumer will also expand. And you have specifically leveraged on the fact that transactions will move away from the easier one to track, which is the bank statements, to actually the M-Pesa platform where you have got an M-Pesa statement. And an M-Pesa statement is actually as valid a document in terms of your credit worthiness as any other. So as long as the controls are in place in the sense that the statement is genuine and relates to you and displaying your transactions, there is no reason why a bank would not rely on that for purposes of evaluating your credit worthiness. You see, when a bank wants to look at a credit application, there are four things that the bank looks for. One is the character of the individual. Then the other one is the credit in terms of the ability to meet your obligations. The first one is the character, because you may have the ability, but if your intention is not to pay back, you'll not pay back. And the bank somehow needs to be able to assess that. Does this person have a character whereby even if he has got the ability, he'll not be able to pay back? Another one may have all the intentions of paying back, but the business, somehow the cash flows don't come in, and so he's not able to. So even with good intentions, he's not able to pay back. Then the other one is on what we normally talk about, which is the collateral. So, you want to get something just in the event that your assessment of the character and the capacity of the borrower to pay back does not quite fall into what you had anticipated. You've got some fallback position. So that's why you get banks taking, for example, a house or a piece of land or some building or some collateral. And then the fourth one, of course, is condition that you put in the agreement to ensure that your loan is safeguarded. So you prohibit from making some payments. For example, you cannot pay yourself dividends until you pay me back my loan. So those are the four things that the bank generally looks at as they are appraising the facility. And back to your point in terms of the fact that I will be looking for evidence of the fact that this person has got the capacity to pay back. And one of the areas that I can get this evidence would be, for example, your bank statement or your M-Pesa statement. Because if I see what you have been able to transact on and pay out, I can then be able to have a feel of your capacity to be able to pay back this. If you have been having transactions of 20,000, say on a daily basis, it means that if your repayment back to me is possibly 50,000 by the end of the month, I've got no doubt that you've got the capacity to pay back that. So I think, back to your question, the M-Pesa statement will be as critical a piece of evidence as any other evidence, be it a bank statement or any other statement that shows and can be verified that shows your capacity to be able to pay back.
So I'll just ask this last question, then I'll ask you for your closing remarks. And this is on liquidity and the response in terms of providing relief, especially for SMEs, but also for individuals as well, especially in the lower bracket of the economy. We all know, and you said it yourself, the liquidity position of the banks coming towards the beginning of this year has been quite good, and it has been good since 2016, when they were not lending because of the interest rate cap that we had. Now, since that was lifted, from what we saw is that there wasn't that much enthusiastic borrowing still. It wasn't happening. So the liquidity is still there, and it's still been growing. It's been growing tremendously, and it is quite a big pot. You know, if you look at it in billions of dollars, it is not small change. Now, in this time where I'll call it that relief net is really needed, and also the micro SMEs really need a lot of help, and they need help in their hundreds of thousands. You know, and we all know the demand side will be a little bit slow to pick up, right? So even if you reopen the economy tomorrow, the demand is just not going to return immediately. Businesses could open, but they'll be cautious spend. Their spend will be cautious. So even a micro SME, if you say, okay, fine, yes, we're going to open the shops tomorrow and for the next 6 months, there might be cautious spending from the public because of just the experience that they've had, which is traumatic in the last 30, 60 days with job cuts, with the salary cuts, and with all the levels of uncertainty that has happened. I think there's need to advocate for this liquidity to go a little bit deeper, right? And into creating something very unique that the private sector from a bank perspective can do without government intervention, so to speak, because we need, as a private sector, everybody, the consumers, you need the micro SMEs for the future. You know, if they all die right now and all these businesses end up not being sustainable over the future, then our medium to long term, recovery, even as institutions, larger enterprises, is challenged. So how can this liquidity position be used a little bit more than what we're seeing being done right now?
Yeah, Gilbert, I think you're right in the sense that I think the challenge we have now is not liquidity. Certainly, there is sufficient liquidity. Not only were the banks liquid enough before the onset of the COVID-19 challenges, but I think also the central bank has come up with a very strong statement of the fact that they are putting everything in place to ensure that banks have got sufficient liquidity. So as I mentioned, the CRR was moved down by 1%, and that in itself released almost close to 35 billion shillings of liquidity to the banks to be able to on-lend. So the point is that the issue is not liquidity. The issue is just the fact that are banks having the risk appetite for that high level of risk that the target potential beneficiaries pose. And that's why in the beginning I mentioned the fact that we do not want to move from a health crisis into a banking crisis. And that's because of the fact that as we stand today, the non-performing loan portfolio for the banking sector stands at about 12.4%. And that's already quite high. I mean, there was a time when we were comfortably in the sub 5%, 3 to 5% range. And that, in my view, is a much more comfortable position. You're having a much healthier portfolio than we currently have. So at 12.4 is on the elevated side. Anything above 10%, I think, is worrying. And so we need to start bringing it down. But with the current developments and the kind of risk appetite that is being called upon the banks to develop, I think that NPL ratio will only go upwards. In fact, there was an estimate that we did a survey from the banks, and most of them were pointing to the fact that with the current requests, for example, of just rescheduling a loan, if they were met, we possibly are seeing at the NPL level being at about 14% from the current 12.4 by the end of the year. So the point I was trying to make is that there is a need for the banks to position themselves to support the economy through this difficult time, but let it not be converted from a health crisis. We come out of the health crisis and walk straight into a banking crisis. I think the cost of coming out of a banking crisis will be much, much more severe for the economy than the health crisis. If you recall the events of 2007, 2008, when we had the global financial crisis, which was purely financial crisis, but the cost of coming out of that was felt worldwide. It was felt globally. And so the point I'm trying to make here is the fact that we need to be careful, be cautious of the fact that as we resolve this health crisis, we still have the banks standing stable and solid after the COVID. And so what options do you have? And I think I had alluded to it a little bit earlier. If we can have a framework where the risk is shared across parties so that banks don't have to bear the full risk. And I'm also alert to your initial caveat where you say that we don't have to wait for government to be the one to step in. What other options do you have? And indeed, I think this is the point at which we have got specialized institutions, either in Africa or globally, that could come in to step in to actually provide that kind of a platform where we can have some level of risk sharing. And this I've got in mind, for example, the DFIs. I've got in mind Africa Guarantee Fund, whose role is purely that. So if they can, we have got, for example, the DFIs, the IFC, the World Bank, the development financial institutions of the European ones, for example, included African, the AFD, the French one, the German. We have got a number of institutions that are actually well structured to be able to come in and jointly create a platform that can provide that risk sharing arrangement with the commercial banks, so that banks don't bear the full cost of bailing out the economy. Because I think that may be too heavy a weight for them to bear, so that you actually manage to bail out the economy, but you're left in the pit, unable to come out yourself. So I think those are some of the things that you can think about in terms of the government may not be able to come in with the required resources to create this kind of a platform, but you've got other parties that are playing in that area that can come in and create a platform that can support the banks to be able to enhance their risk appetite and therefore support those particular SMEs that you've been talking about, whose risk profile is on the higher side, but who may not at the current rate be able to access the credit from the banking sector.
Dr. Bill, you just gave us the topic for the next webinar, right? With these DFIs and AGFs and the critical role they need to come out of the shadows and start playing strongly. Probably they are doing it already, but it would be great to hear that debate in the public. So thank you so much for that. And thank you all for your questions. That marks the end of our Q&A. And I would like to ask Dr. Bill Olaka to give us his closing remarks. Just before he does that, because I want to steer him towards positivity. There's enough negativity on the streets. The disruption we have now is a black swan event. We all agree, right? There are two types of disruptions. There's incremental disruptions, and there's the high impact, low probability disruptions, which we call the black swan events. And we all agree that COVID-19 disruption worldwide is a black swan. Now, black swan events also do create opportunities for all of us, right? They create opportunities both for those who can innovate, evolve faster than everybody else, literally revolve their businesses and themselves faster than everybody else, and figure out how to take advantage of that opportunity and create new business models, new products, new customer engagements, and basically innovate and start to create a platform that they can use to actually accelerate the businesses as well. So on the back of that, would be great to hear from you your closing remarks, especially on the Kenya's banking sector as the FSI lead across Eastern Central Africa, how your sector could use this Black Swan event as a platform towards much greater things. Your closing remarks, please.
Yeah, thank you. I think this has been a very engaging discussion. From the questions that were asked, from the leading discussion that you led, I think it has been very informative. Not only for the, I hope for the participants, for the audience, but even for me as well, because it has opened some areas that I possibly hadn't given as much thought to. But now, given the props that you have given, I think we may have to also give a bit of thought to some of the areas. But I think in my concluding remarks, I would just like to restate what I had mentioned a little bit earlier about the fact that banks are ready and well placed to play that supportive role for the economy. I know everybody is possibly looking at the future is looking fairly gloomy, but I think banks are there and they are well positioned for that. As I mentioned a little bit earlier, liquidity is not a problem. I think there's adequate liquidity in the market. And in the event that banks are falling short, central bank is ready and it has given its commitment to the fact that it's ready to stand behind the banks and give them all the support that they require to be able to get the economy out of the current situation. The other point I mentioned earlier, the fact that banks are actually adequately capitalized. Fortunately, something that was put in place a little bit earlier for times like now, when we come across shocks and we then have got to fall back on our capitalization to be able to support the economy going forward. And then finally, I think beyond COVID, I think we definitely will have a very changed environment, not only because consumer tastes will change, but also even the way we operate will change. And the critical thing will be that we all position ourselves to support the evolving environment. As banks, I think we are in the laboratory, trying to ensure that as the environment evolves, we are learning as much from it as possible and positioning ourselves to be the anchor for the economy, given the changing tastes and given the changing ways of working. I think banks have got to be also agile and be able to move with the times, so that the traditional brick and mortar bank that you knew a little bit earlier will be miles behind by the time the COVID is out of the way. So banks have got to be agile, have got to be very innovative, have got to jump to the table, so to speak. As things are working, you've got to be on the table and be ready to change your way of doing things as well to meet the new demands that are coming into place. So I think I would like to leave you with that, on that positive note of the fact that things may look gloomy, but I think if we put our thoughts together and the various sectors work collaboratively, and each one of us playing our role in the changing environment and being agile and changing accordingly based on the changing environment, I think we should be able to see through this.
Thank you very much, Dr. Habil, CEO of our Kenya Bankers Association. We were privileged really to have you this morning with us and to spending time and being the only one in the office, near office at this time. We commend you again for the level of preparation that you prepared the institution towards this kind of circumstances, and they're able to really execute flawlessly, especially on some of your critical infrastructure, like the exchange platform for money transfer with PesaLink, that everything is going on smoothly, even though they're not in the office. We really have to commend you for that level of preparation that you've done in your institutions. And for the rest of the audience, we really do thank you for attending. This cannot be what it is without you and your questions. And thank you so much for your informative questions. We appreciate you, and the recording will be available will be available on YouTube. So just look for YouTube/Ajua webinar series, and you shall find the recordings there within 24 hours from right now. But again, Habil, thank you very much. Stay safe. We look forward to having you another time. And thank you for honoring us this morning with your presence and with your insights from your institution and you as the CEO. Thank you very much, everyone. And stay safe, stay home, stay alive as a business. Thank you. Well, bye from Ajua.
Thank you.
Thank you.